In this video, I want to show you the single price level you should be using to make any trading decision. If you want to be profitable this year, watch this video till the end. Now, before you have an understanding of the single price level, you have to know the anatomy of a candlestick. Okay, every candlestick has the open, the high, the low, and the close, HOLC. So when a candle open for a bullish candle, we are going to have the open here. Price will first of all go down, meaning price will have traded lower like this, get to the low, and then come back, push up, push up, push up until it closes for the day. All right, before it closes, it goes high, then come back and then close. So all the 4 points that you need to understand in a candlestick is the open, the low, the high, and the close. So if you look at this market movement here, market opens here, trade lower to the low of the day. Let's assume this is a daily candle. When the market opens, it trades lower. That trade lower creates the wick. This low and this high are the wick. So when price trades lower, creating the wicks, and the day wants to be a bullish day, what happens? Price will start trading upward, get to the high of the day, which is here, and then trades lower and then close at this level. All right, so this is for a bullish candle. Now this candle is formed on any time frame. If this time frame is to be a 1 hour time frame, what it means is that price will open here, trade lower within that 1 hour window. Within that 1 hour window, it trades lower, comes back up, trades to the high, and then close at the end of the hour. And that is how every candle you see on those time frames are being formed. For the bearish candle, you have the open on top. In this case, market trades lower and close lower than the open. When the closing price is lower than the opening price, we have a bearish candle. When the closing price is higher than the opening price, we have a bullish candle. So let's take a look at the anatomy of the bearish candle. Market opens here, trades higher, comes back down, trades to the low, and then closes. So let's picture this as a daily candle. For the day, the market opens at the day, trades to the high of the day. A lot of sellers comes in, price trades lower to the low of the day, and then eventually closes at the close of that day. And remember, these candlesticks are formed on all the time frame, from the monthly, weekly, daily, 4 hour, 1 hour, and down to the 1 minute time frame. So if it is 1 minute, this candle is being formed in the 1 minute. So the market moves this way, trades higher. When you look at it in form of structure, the market trades higher, comes down, trades to the low of the day, and then close eventually. So within a single candle, there are so many price levels here. There are so many prices from this point to this point. There are different prices attached to this, but I'm going to show you one price that you should be focusing on, one price level you should be focusing on. All right, and that price level is the opening price. Is the opening price level. This is the only price you should be forming your trading decision around. I'm going to show you with examples on the chart, and then we're going to run through a quick trade analysis and see how powerful this level is. Now for the bearish candle, the opening price will be the most important price you should be looking at. Now, we have some times where the market is inefficient. That means for efficient market is when the closing price equals the opening price. Now, for efficient market, the efficient market is when your closing price equals your opening price. This is the most ideal price action you should be trading. But what happens when the market is inefficient? When that happens, the closing price will not be the same with the opening price. For example, if we have a closing price down below, for efficient pricing, both the opening price and the closing price will be at the same level, like this. This is price efficiency. Because if a market closes yesterday at a particular price, when the market resumes, it should open at that same price and then continue trading. But in an inefficient market, we are going to see where the market opens, trades lower, then the next day market jumps. That's where you see the gaps. When you see the gaps, it's a sign of inefficiency. So what you need to do in that case is to take your line, the most important line, back to the original place it was supposed to open. And most times, price will have to trade back into that level before moving. So take note of this. We are going to go to the chart and then examine the opening price, which is the only price level you need to formulate your trading. That is the only price action you can use to profit week in, week out in the forex market. So without wasting time, let's go to the chart. So this is a daily time frame for Euro USD. And I'm simply going to point to you those levels, and you see how price sharply respect those levels. Now, how do you make your trading decisions around those levels? It's very simple. What we want to do is that when price comes to that level, let's say the next day we want to trade and we have a previous price level there, we want a situation whereby price will come to that level and then we form a trading idea around it. So if you look at this, let's simply look at the data from September 2024 down to January 2025. Let's just take a look at that. So from here, we can see that we have the opening price here on this candle. You can see price opens here and trades lower. So when price came in here, this is where the reversal comes. And this particular price level here, I call it the reversal opening price. If you have not checked my opening price trading strategy video, I will put the link in the description. So make sure you watch that after this video. And I also create a playlist where all the videos concerning the opening price are placed. So you can go there and watch them one after the other. So as you can see, price trade into the reversal opening price and then rejected. It is a sign that price wants to trade lower. What you need to do is you go to your lower time frame and use your entry model in here to formulate a trade. If you go down here, we have another one here. In this case, we have another reversal opening price. Price went in here, came back down, closed below. So we have an opening price here, forming the reversal opening price. What happened? Price came straight into it, but rejected, and we started flying. Now, in this case, as we started moving, we moved with huge momentum. There was no room for price to come back and trade back into any of this opening price. So the only place we see is this level. Now you ask me, which level is this? Let me use the magnet tool. Now, if you look at this candle here, you are going to see that there's an inefficiency around that market there. We have inefficiency here. Why? When the market closes, the next candle will have opened immediately along the same price here and then push up. But what happened? It jumped. So this is an inefficiency in the market. And as you can see, price came back down to the opening price before pushing. So we are going to draw a line across this and then formulate a trading plan around it. So when market closes below this was initially a support. You can see how price rejected there, went up. But this time around, price broke it. Now it becomes a resistance. All right. So this is the only price level you should be looking at. So when price trade back into it, you can go to your lower time frame, look for entry model, and take this trade to the downside. And as you can see, the price pushed down, went down, went down. We came to this level. We rejected that level. And in this case, you can go to a lower time frame to look for bullish price action. But I have some certain things that I look out to know if the trend is over. If you want to know this, you can join my VIP Elite Traders program, and I will definitely show you how it's being done. So market closes below. That means we continue going lower. And as you can see, we created an opening price here. Now, this in this case is an inefficiency because there was a gap. When there's a gap, there's inefficiency, and there's tendency for price to push back in. And when price comes in there, that is where you formulate your trades to continue going lower. Same thing here. Okay. We have a close here. Market open for that day. Now the third candle needs to come back in. Rejected. You can look for a trade around here to trade to the downside. And market continued that way. You also look at your left here. When you look at your left, you see that we closed below. And then immediately we close above. There is no form of rejection. That means you can take a bullish trade from here. As market comes back in here to retest this area, it push price to the upside. The same thing here. We have an opening price. So this candle here came all the way down to respect that level and then push higher. Okay. So as you can see, these are very key levels you should be focusing on. Now, what people do that is wrong is that they mark out their levels in form of zones. They mark out their levels in form of zones like this. Now, the problem with zones is that I cannot accurately know if this zone has failed me or is going to work because there are multiple price within this zone. So if price close above price A, is it going to go higher, or must it close above price B or price C? Because within this level, we have multiple levels here, price level. So the first one is this one, second is this, third one is this, that I can just draw on the chart. Within it, there are multiple. So which one will signify that the zone has failed? Is it when price close above the first one? Or is it when price close above this? Or is it when price close above this? So there's a lot of confusion there. And that is why I've narrowed down my support level to the opening price level. That is the single price level you should be focusing on. And if you can see, go through your chart, you're going to see it plays out week in, week out. day in, day out on your chart, and you can easily frame a trade setup for it. Price respected those levels, closing below this, came back to retest, went lower, and eventually we came to this level, which in my live stream I talked about that level, which is this here. You can see all the way back is still very valid to trade off from. All right, so there was a rejection there, and this market is very bullish on the Euro USD. So I would like you to go back test this and put in the comment section what you think about this, and also let me know the areas you struggle with in trading. So if you want to know more about my opening price strategy, you can check this video in the description.